So good afternoon, everyone. My name is Francesco Petruccione, and I'm the interim director of NITheCS, the National Institute for Theoretical and Computational Sciences. Yeah, and this afternoon, I'm really very pleased and excited to introduce to you the speaker of today's mini school, mainly because this is the first ever mini school on a topic of quantitative finance within a NITheCS activity. And we are very grateful to Dr. Mesias Alfeus for offering this course. Yeah. Mesias is a senior lecturer in the Department of Statistics and Actuarial Sciences at Stellenbosch University. He did his undergraduate study at the University of Namibia, but he has an honors and master's degree in quantitative finance from Stellenbosch University, after which he completed his PhD in Australia, yeah, at no, I forgot, at the University of Technology in Sydney. Sorry, yeah, and after a few stations, he ended up again in Stellenbosch, where he's now a senior lecturer, as I said. Yeah, and Mesias is very important to NITheCS, because, as you know, NITheCS covers several disciplines, yeah, not only theoretical physics, which was the original activity, but also mathematics, statistics, data science, astrophysics, and the quantitative and computational aspects of finance, biology, and Earth systems and climate change modeling. Yeah, and Mesias is one of the PIs, or the leading PI of the quantitative finance research program of NITheCS. Yeah, and this is part of his activities to raise interest for the topic in the country. Yeah. So Mesias, people are here to listen to you, not to listen to me. Yeah. I see that you already started sharing your slides. Before I invite you to start with your lectures, I just want to remind the participants to please make use of the Q&A facility at the bottom of the Zoom screen to ask questions. And at the end of the lecture, you can raise your virtual hand and I can give you the opportunity to ask a question in person to Mesias. Yeah. So Mesias, welcome. You're most and welcome to start with your lecture. Thank you very much.
Yes, thank you very much, Francesco, for the opportunity to give this mini school for the next 3 to 4 weeks. And like Professor Francesco said, my name is Mesias Alfeus, and I'll be taking you through for the next 4 weeks as an introduction to quantitative finance. Quantitative finance, or sometimes it's closely related to mathematical finance. And so this is really a basic introduction to the course of quantitative finance or mathematical finance. We're going to keep it relatively simple, just to introduce you to key concepts of quantitative finance. But as for today, we're just going to look at some financial instruments and financial market and financial instrument, but relatively at an easy level. So this is for week 1. So we'll take you into the financial markets as well as the financial instruments that compose of the financial markets. So the agenda for this lecture, I'm going to introduce you what is the key concept of finance, and then what is the capital structure of a firm. Then we'll look at the financial instruments. Mainly, we're not going to go deeper into it, but just to give you a glimpse of what are the bonds, what are the stocks. And then we look at the time value of money. This is one of the key pillars of the finance, which is the time value of money. And we'll also look at what we call the yield curve. This is the term structure of interest rate, how different yields are, how different rate of different maturities are related to each other. And then we look at what we call the discounting factors. If you want to find the value of a cash flow, or meaning the value of a financial product in the near future, how do you now what you want to do is to find the value today. So we're going to look at what is the discounting and forward rate, also the bond pricing, and in this lecture. But we're going to keep it relatively very simple. What is, if someone asks you what is finance? How do you answer? What is finance? Finance is a discipline that deals with the studies of how people allocate, or they spend or save scarce resources. In this particular case, we mean money. It's how people spend or allocate the scarce resources over time. And this is the study, what we call finance. So finance is divided now into, so there's corporate finance, there's behavior finance, and there's quantitative finance. Quantitative finance is the topic of today, and we want to introduce this is to use now the mathematical approach to examine how people can allocate or spend or save money, or maybe in particular, be able to use the mathematics to be able to prevent or to minimize the risk that's associated with allocating scarce resources into different portfolios, or maybe say savings. Now, to distinguish features of the financial market, especially with the decision making, at the outcome of the decision making, meaning the cost and benefits, it has to do with the spread over time. How if you are say saving money into the bank account, you spend it depending on the time frame, as well as the risk that is associated with it. Maybe the inflation, or maybe interest rate will go down below a certain level, and then so there's sort of uncertainty associated with the allocation of these scarce resources, which is the money. And then in this case now, especially with the mathematical finance or the quantitative finance, we want to exhaust or we want to exploit, or we want to explore from the mathematical point of view to see how can we make sure that our scarce resources are well managed, meaning we make sure that, of course, there's a risk associated with this, but we want to make sure that if we are supposed to lose, say, 10 million, we are now only going to lose, say, 1 million. For instance, we want to make sure that we provide a hedge using the mathematical approach. So the basic foundation of finance rests on 3 pillars: time value of money. This is depending on how long that you save, what's the difference between the money I have today and the money I have tomorrow? It has to do with the time value of money. And then we have what we call valuation. In finance, when you say the valuation, if you have an asset, if you have a property, then valuation means is to find what is that value of this property or the value of the asset. In this case, in terms of asset, we have what we call the stocks, or what you have bonds, or what you have also derivatives. In this case, derivatives will also become clear either today or in the next lectures that we're going to have in the next few weeks. So derivatives is a financial instrument or a financial contract whose value is derived from another underlying variables. So those are the derivatives, and derivatives actually make one of the most important part of mathematical finance or financial mathematics. Or risk management. Risk management deals with making sure that we manage the risk that we are exposed to. This includes if you have, say, a portfolio of, say, million that you're managing, you want to make sure that you take offsetting positions so that if the losses from one position will be offset by the gain from another position. So that's what you call you creating up a hedging portfolio to make sure that your portfolio at any point in time is hedged, meaning the risk is mitigated. So this is what we deal with risk management. Okay, well, then I'll take you through a firm, the capital structure of a firm. The primary function of a capital market is to actually allow a firm or an economic entity to raise funds. In order for a firm to raise funds, it can do the following. It can either borrow money. If a firm now borrow money, is obliged to pay interest on the amount that is borrowed. So the lender of the firm is called the debt holder, or sometimes it's called the bond holder. Or the firm can also raise money or funds for its project by issuing a stock or maybe a share of equity. In this case, no obligation of a performance or no guarantee of positive return on investment, but a shareholder gets sort of like a share of a gain or losses and a partial pro rata of ownership of this firm. So this is actually two ways a firm can actually raise funds for its project. Then a firm can issue a debt. This is what we were just talking on the previous slide. It can issue a debt or equity to private investor through organizing what we call a stock market or what we call the debt market. If a debt or equity is issued into a public market, it can then be traded as what we call the financial instrument, meaning passed on from one investor to another. And then these financial instruments are the one that we call now what we call the derivatives, because it is sort of transferring a risk from one entity into another entity. So this is typically done in the stock market for shares. Please take note of this. Stock market will come up over and over again. And then also in the debt market or what we call the bond market for debts. This one is mostly for long time maturity, and the stock market. These are the ones that are most popular in the financial market or in the capital market. Okay, well, if you have an initial, say, budget of say £1 million, and then so this is say owned by a partner of the firm, and then you also have equity, which is like 4 million, which is issued by shareholder. Then the whole total equity now, which is owned by the shareholder, is like 5 million, and this is the debt, which is owned by a debt holder. The balance sheet of a firm, so now we're going through now the balance sheet, is typically divided into share, and a share typically means that it represents the ownership part of a firm. So that's what I mean by a share. So, and then if we now want to involve the technicality of the mathematics, if you consider, say, a simple loan, which is contracted today, and in quantitative finance or mathematical finance, so we normally represent small t equal to 0 to represent current day to day. If we get a loan, say, N, which is a notional amount, is normally represented by N dollars. And then at maturity is the day that we have to pay back the money that we borrowed. And so we pay some amount, which is D. Normally, this amount that we have to pay is bigger than the notional amount that we borrowed. It's bigger because this D includes the interest that we have to pay back because we have borrowed some people's or some money from a bank account, say for instance, or from somewhere else. So a simple loan, one payment, and get a loan of, say, a notional amount N. So now you have to repay an amount which is called D, and this amount D is bigger than what you have borrowed at maturity time. So typically, the fraction between the D and N is bigger than 1 because this D contains the interest that you have to pay for using somebody else's amount. And the ratio, the quantity D over N minus 1 is what we call the interest rate associated with the loan that you have borrowed. I hope that is clear enough. And so we represent R to be the interest rate on the loan, and this R is given as D over N minus 1. Each year, a borrower pays an amount R in percentage of the sum of the total amount of the loan that is borrowed. For example, if a bank account with R% annual interest rate, after T years, if you borrow N, after T years, this is just a non-simple interest rate compounding. So this is, you borrow this today, then and then if you invest this up at R, then at the end of the period, you have N multiplied by 1 plus R to the power of your compounding period. So now if you invest this amount today, at the end of your investment period, you're going to have this, where the investment period, at the end of your investment period, again, we denote it as like the maturity of your investment. Well, now interest rates, which is charged on a loan, is typically depend on the duration. If your duration is very small, then the interest rate also depends on that duration that your loan is taken. So typically, we call what we call the yield, which is represented by Y, subscript T, capital T, meaning is the yield at time T, small t, with maturity, with capital T, is the annual rate of interest rate on a loan, which is starting from small t and ending up to capital T. So now if you invest £1 here, at the end of your maturity, you have 1 plus your yield multiplied by 10 to the power of capital T pound. So this is if you invest £1, then at the end of your investment period, then you have this amount in your bank account. Now the map, which means mapping T to this yield, is now what we call the yield curve. How different rates with different maturities are related to one another, and this is called that curve is now what we call the yield curve. Of course, like what is given here, the yield curve is specific to an issuer or a borrower, depending on the term structure of the interest rate or the duration of their loan. Okay, I hope we are all doing well. No question. Okay, so far question. Then this is just an example. So if you can put a link here for the South African Treasury yield curve is now, if you have a loan which is borrowed for 3 months, the annual interest rate is 9.15. They're actually higher than the US, for instance. This is what was the yesterday rate, but this is today's rate. The is for July. And you can see that the yields depend also on the duration. But of course, you can see here that for longer term, especially the 30 years or 20 years and 30 years, the yields are pretty much almost close to each other. So again, just to summarize, the yield is just the different rates and different maturities are related to one another, and that's the yield curve. Now, in this case, I just provided the yield curve for the South African Treasury bond. Then this is probably from the basic theory of interest rate for the payment with more than this. So far, we only discussed with annual frequency, meaning only once a year. But now there's typically examples whereby you compound it many times a year at a discrete point, say n times per year. And now we want to come up with a formula for that. And this is coming again from the basic of the theory of interest rate. Suppose now, for example, n is the number of payments per year, and the annual rate in this case is given as capital Y T minus 1 T. So those are the annual rate paid. Then if you invest n amount, the notional amount is n today, at capital T or at maturity, then you are going to have n multiplied. So this is really discrete compounding. So you have 1 plus y over n to the power of n in 1 year. And this is as compared to if you only do it only once. In this case, it's only when you only once per year. You're compounding it once per year. Okay, so now in this case, if you have R is like what you have here, then you have R over n, and then you do it n times in 1 year. Over multiple period, so if you invest n amount in the bank account, but now you do it multiple period. So now within the first year, you have the rates R, and then the second year, again, you have R, the second period from the R, which is applicable at, say, compounding 1 up to period 2, and so forth. Then now you also have from period T minus 1 up to period T, but you all have to divide by n. Then what is if the payments are frequent? Okay, just now if they are not, so far what we've discussed is only you discrete n times. But what if you let this n to be even bigger, say 1,000 or 10,000 times? You'll be making n approaches infinite. So then again, for those who don't have enough mathematical background, don't feel left out here. If we have, this is for discrete compounding, and then we letting this n goes to infinite, we end up with a letter E, which is the error to the power of this R. The error number is 2.7. I think this must be very clear to everybody. And how do we get up to E to the power of X? We get, if you let the limit of this, I think I've done it somewhere here. Sorry, I've been. So you write the limits as n goes to infinite, it approaches this number. To prove this, you apply the limit. If you have a limit here, if n goes to infinite, so here you're going to have 0. and then you have 1 to the power of infinite. And this is 1 to the power of infinite. That means you're not going to have, you have sort of one form where you can apply the L'Hopital rules. And then if you apply the L'Hopital rules, then you can end up with this e to the power. I mean, again, this is just a basic introduction to theory of interest rate. But if you have 1 to the power of infinite, what you can do, you can apply logarithms on both sides. You can apply logarithms. Then now you have log of 1 of bracket 1 plus x over n to the power of n. You apply log, then you're going to have n down and then log of this. So now you have this. If you check, if you take this n and then you take it x to this side, and then you apply the derivative on both sides, then at the end you end up with x here. I think they said that for here, you take a derivative of that, and then you have x. And then at the end of the day, the limit of this approaches e to the power of x. Now this is the case when you do it continuously compounding. Then you end up with, if you put your money, if you say put $1 in the account, then after some period of time, any interest rate, say R0, then you can either have 1 plus the interest rate, or if it compounds continuously, then you have e to the power R0 times your period of compounding. So now we have 2 types of compounding frequency. You either have the continuously compounding, or you have the discrete compounding. So, and let me see if there's no question. Okay. Okay, no question so far. Okay, well, now there's this concept, probably very important, because what we call the present value. What is the present value? Meaning, if you have some cash flows that are known, or maybe not, uncertain in the future, you want now to see what is the value of this today. So you project some value in the future at some time, capital T. What you want to do is to project what is the value today. And this is what we call the present value. So what is the value at time T equal to 0, meaning today, for the n notional amount, n dollar paid at time in the future? And that's what we call the present value. This is an example where we need to assign a value to a future cash flow in order to be able to, and probably this is now one of the most important concepts in financial mathematics or financial econometrics. It means, or economics, sorry, it means that in the financial market, there is no free lunch. There is no free lunch. It means that no one should be able to make money from nothing. So in order to be able to use the mathematics to find prices, and this is actually also very important because all the mathematical formula in finance or quantitative finance are derived from the concept of no arbitrage. Because if there is arbitrage, then that strategy will not last longer, because everybody will rush for it and then exploit it. And then so it will eliminate, it will boil down. It will be eliminated as quick as possible. So in financial mathematics or mathematical finance, so we say that we use the mathematics to derive the prices, and we assume that you cannot make money from nothing. And this is what we call the theory of no arbitrage. And this is coming also in some of the lectures that we're going to do in the coming weeks, where we're going to derive up some formulas using the concept of no arbitrage. And there is this law that is called the law of one price. The law of one price says that if two cash flows have, or two investment strategies have the same price at some maturity capital T, or at some maturity, say, future date T in the future, then these two investments must have the same price today. Otherwise, there is arbitrage. Then normally how one can exploit that arbitrage opportunity is to actually, you want to make sure that you're up, because then you buy the cheaper strategy and then you invest it, and then at the end of the day, then you profit. Or you buy the cheaper, you sell the most expensive, and then you end up with money from nothing. But now, in order to use the maths, in order to find this formula, we say that there is no arbitrage in the financial market. Okay, well, just to recap again, and again, this is really simple, is to find the present value. You invest this amount X today, and the investment period is of length T, capital T. And then after investment, your investment is earning the rate, which is YT. After the investment period, if it's compound annually, then you have X, which you put in the bank, and this is multiplied by this. And again, this is really simple. This is when you have discrete compounding, and this is when you have continuously compounding, where your Y is your continuously compounded rate. Your Y is 0 here. Yeah. So now, if this capital Y is the annually, or capital Y is 0, subscript 0T, is your annual compounded rate. So now what we know that at capital T, we're getting some amount, which is N. Then we want to find what is the value here at time 0. So now what if we want? So okay, well then you say, okay, this, you can either use this or this. Annual compounding, this is the continuously compounding. Then you said, okay, well, N is equal to that. And then you solve for X. Solve for X means making X the subject of the formula. And simply you have X must be equal to N divided by 1 plus if it's continue, or if it's annually compounded. And then here definitely this is pretty simple. And then this is when you do it continuously compounded. So meaning you equate this is equal to N, and then you solve what is this value. The X is now what we call the present value of this at time T equal to 0, like the time today. Then, of course, the cash flow is this. That means the cash flow today for some cash flow known in advance. So now this factor, the factor 1, which is this factor, if you only consider, don't put the notional amount, if you only consider this factor, is called the discount factor at time T or small t equal to 0 for maturity, capital T. So this discount factor, it represents the present value at time today for one payment. If you have $1 payment at at capital T. The discount factor is actually a monotonic decreasing function of time T. And the slope, you can find the slope if you just find the slope of a curve is equal to, you just find the first derivative of this function, which is the discount factor. And so it will be, it starts from usually 1, because if your rate is at time 0, then it's a decreasing, monotonically decreasing function of the maturity. Are we all okay? Okay, no issue. Excellent. Now we jump into what is bonds, and in particular, we're discussing what we call the zero coupon bond. The zero coupon bond is the bond that pays no coupon at intermediate times before maturity. So if you borrow, say, N, you just have to pay N at maturity. So you just have to pay only some amount at maturity, no other intermediate payment before maturity. So a zero coupon bond, it pays a fixed sum N notional at some date capital T in future, meaning T, like what we represent, is actually the maturity of your bond. So now the value at some times before maturity of the zero coupon bond is now what we call is Z, meaning it's Z, it's represented by the notional, and then you multiply by the D, which means the discount factor of time, the current time with maturity capital T. Which means if you consider the continuously compounding frequency, then you have N, then you have N, which is a notional amount. Say if you put in $1,000 for rent, then you multiply by E to the power. This is just a compounding frequency. Then you have, because definitely you are deflating, you are discounting, where this amount, the coupon bond must be less than your notional amount. Meaning the value of the zero coupon bond must be equal to the notional amount put in the account multiplied by the discount factor over the time period of your investment. The market value definitely less than the notional value, simply because you are deflating your notional amount by this interest rate, and this interest rate is positive. The market value decreases with maturity, and this is what I told you, that the coupon curve is monotonically decreasing with maturity. Then we have what we call the coupon bearing bond. The coupon bearing bond is the bond that pays coupon either, say, every 3 months or every, say, at some intermediate steps. So now the present value at time T equal to 0 of the stream of cash flows. These are the cash flows, CM, meaning represent the cash flow paid at some time, at some intermediate time M. So that means it's paid at time TM, where we have M is equal to 1 up to N. So if you are standing right here, and there are some coupon, the first coupon is paid here, the second coupon up until the last coupon, which is paid at time capital TN, T small n. So now the value of this bond must be equal to the sum of your discounted cash flows, meaning you add now the sum and then of the cash flow, but you also discount them at all this particular time. Meaning the present value at time T equal to 0, small t, of all the cash flows. So you basically take the cash flows and then you discount them. But now the value of this bond, so you have to add the discounted cash flows plus at maturity. At maturity here, the notional amount must also be added to. So now in this case, we'll give an example of how to value a bond. So to value a bond, in this case, you discount all the cash flow as zero coupon. I mean, this case is a coupon bearing bond. You add all the cash flows plus again on this particular day, which is the maturity day, you have to add the notional amount on the payment for the maturity day. Okay, consider this example. The coupon is called a coupon bond or the coupon bearing bond, has a notional or the principal amount of $1 million. The maturity in this case is 10 years, and the fixed coupon, meaning fixed coupon is 5% per annum, and the frequency here for simplicity is given as annually. And what we want to do is to find what is the value of the bond at time. If we say what is the value of an asset or a bond, we simply means you have to find the present value of all the cash flow. So that means the value of the bond at time 0, which is noted by B0, must be equal to the sum of all your coupon. This is what we discussed. It's the sum of the present value of your coupon, plus now at maturity date, you must also add the notional amount, the discounted value of the notional amount at maturity. And so if you factor out n, take n out, and then you end up with, if you take n out, then you have c, the sum, and then you have D0, meaning this is just the present value of one, which is mainly at maturity. But if you see that this one here is affine in C, meaning this is just the sum multiplied by C plus that. It's affine because it can be written as C times X plus some B0. So it's some constant. So it's an affine function. So now the present value of a bond does depend on the coupon rate C. It is an increasing affine function of C, meaning if C is this one, and then you have this is now the present value of the bond, it's an affine function. Here I even put it here like it's an affine because you see that you have C multiplied by this quantity plus this, which is sort of like a constant. But I'll get into that later. So this C, this small c, is called the coupon rate. It's the rate that you have to pay if you agree in the when you enter into contract. It's a rate that you'll be paying at some intermediate period until maturity. There exists a unique value of the coupon, which is denoted by C par, meaning a coupon par, such that this quantity here is equal to 1. If the value coupon C that makes this value here equal to 1 is what we call the par coupon rate, or the par yield of the bond, if we're talking about in the bond. So now, in this case, the value C, or the value C that makes this affine structure equal to 1 is called the par coupon, or the par coupon rate. Okay, then again, then we go through some terminology that are used in the financial market. We say if the coupon rate is bigger than the C par if it's less than the C par, then we say that a bond is trading at it's a discount bond. In a nutshell, it's called a discount bond if the value of your bond is less than your notional. If the value of a bond is bigger than the notional, or if the the coupon rate is bigger than the C par or the par coupon, then this bond is traded at premium. It's called a premium bond. And when your coupon rate is the same as the C or the par coupon, in this case, the bond is a par bond. It's a par bond. Now, if C, which means is a coupon, is equal to C star, in this case, it's called a C, the par coupon, at the issue date of the bond, we say that a bond is trading at par. Okay, again, let me see if there are any questions. My class is very quiet, or am I missing something? Okay, no. Then we look at also one aspect of what we call the forward interest rate for the period. Okay, well, here I really need to represent capital T. If you have capital T minus 1 up to capital T. Okay, well, here I can just explain through here. I'm standing here today. I want now to see what would be my interest rate that would be applicable from capital T minus 1 up to capital T. So because it's the interest rate that I'm seeing it from today, but this interest rate will only be applicable from this time in the future, some time interval in the future, then this interest rate is called the forward interest rate. Simple as that. So then we denote it by capital R, subscript small t, meaning it's the interest rate applicable at time small t. But this, okay, well, it's the interest rate seen from time small t, but only applicable in the time interval in the future, which is capital T minus 1 up to capital T. So meaning only in this interest. Meaning it represents the interest rate agreed upon at date for a loan starting, meaning it's applicable today or at instant time t, but only applicable for a lending time t minus 1 up to ending up to t. Okay, so small t is today. This is the starting point of the lending period, and this is the ending time of the lending period. Meaning, it's the interest rate agreed up to date, but will only be applicable from this interval. So these are called the forward interest rates. Okay. Then if we look at the relationship between the interest rate, the yield curve, and forward rates, and this is what, if you really want to, this is what we call, this is the formula, but this formula is depending on the no arbitrage principle. Suppose, just to say, as a simple example, if you have 3 maturities, so if you have 3 times, you are standing right here today, and then you have up to time t minus 1, and then there is another forward rate which is applicable from t minus 1 up to capital T. Suppose if you put money today, that will be applicable from today up to t minus 1. And then again, whatever you get here, you don't withdraw your money from bank account, you reinvest the gain, but you're going to reinvest this amount of money with this interest rate, forward interest rate here. Then you're going to have this. But the yield today, from today up to maturity, is capital YT with maturity capital T. We can actually, there are two ways to do investment. That means I can just invest my money here and then get it at capital T, or I can invest it here, roll forward, using now in this interval, I'm going to use this. Before the global financial crisis, this of course was right because it depended on no arbitrage. It's a textbook approach. But after the global financial crisis, formulas that were true, like this, sort of like this typical like forward rate agreement contract, they broke up because they realized some of the risk in the market. So just to illustrate, it's an illustration, assuming that this is true, but this is how it is. I can do two ways of doing investment. I can put $1 in a bank account today, earning at the yield, which is YT, which is now the yield for this period. And then at the end of the investment period, I get this. Or I can invest here using this investment rate up until this. And then I roll forward using this forward rate for this period here. But now, the concept of no arbitrage, it means that these two investments must have the same value. Otherwise, then again, it goes back to the law of one price. And then in this case, then you make this equal together. This investment plus that investment must be equal, otherwise there will be arbitrage. And then if these are equal, then you can make R, meaning your forward rate is subject to formula, and then you can find the equation for your forward rate, where this D is just the discount factor, which is obtained from this yield. Again, very simple from the basic finance theory or interest rate theory course. Okay, well, now this is probably my last slides of the lecture. So if you invest here now, this is a relationship between continuously compounded forward rate and spot rate. The spot rate is the rate that is applicable now, while forward rate is the rate which is applicable in the future. If you invest a notional amount N, and then you have at the end of the investment period, because you have N to the power E, for this are the rate, which is called the spot rate. And if you do it annually compounding, then you have this. If you do it on the continuously compounding, which means this Y0 is just the continuously compounding rate. And then you have, and R0 here, we just represent the forward rate. And in this case, what you can do, if you make this equal to this one here equal to that, then you can make Y0 the subject of formula, and then you end up with 1 over T, especially here, 1 over T multiplied by the sum of this rate. So in this case, we can already see, because here what you do, you invest it from this period, it means the spot rate, which is applicable here, and then here again there's a spot rate from another time interval, and then you continue like that. So now in this case, we can see that the continuously compounding spot rate for maturity capital T is actually, which is this one, is actually the average of the continuously forward rate. This. And so this is what we can derive, that the continuously spot rate for maturity capital T is actually equal to the average of this rate. And I think this brings us to the end of lecture 1. Let me see if there are some questions. Yeah. I have a few questions. Are you following a text or personal note? Yes, in this, I'm just using my own notes. I'm not, but I think the book by Hal should really be sufficient, especially the first 4 chapters of the book by Hal. John C. Hal must be really sufficient for this lecture. And another question is the law of one price a pure mathematical law also implemented? Okay, well, the book is future, forward, and other derivatives. I'll take it here. Here, this book by John C. Hal, which means is the option futures.
Mesias, would you mind, sorry if I interfere, would you mind typing the title in the chat so that everybody can see it?
Okay.
Thank you very much. Sorry for that.
Do that. Themes. Okay. The book is Option Futures and Other Derivatives. Yeah. Thank you. And there's another question that says, is the law of one price purely mathematical law or is implemented by financial regulators? It is something that has to be implemented in a financial economics because otherwise there is arbitrage opportunity. And to avoid arbitrage opportunity, we must enforce the law of one price. And this is where most of the financial mathematical financial economic equation or formulas hinge on. They all depend on the law of one price that excludes arbitrage opportunity. Is there other question? Okay, there is.
I don't see any further questions. Yes, if someone wants to use the microphone, you have to raise your hand, your virtual hand, so that I can give you the rights to access the microphone. Here we go. Hector, you're welcome.
Can you hear me?
Yes, I can hear you. Hi.
Thank you so much, Doctor, for the lecture. I just wanted to know, as far as the law of one price goes, isn't this the realm of cryptocurrency kind of like a hotbed for arbitrage, like you said? How does one implement it in that kind of scale? Do you have any kind of insights as to how one could preserve?
For the cryptocurrency?
Yes.
Yeah,
especially where a company has luxury to create these tokens, which
so that's why
arbitrary value.
Yeah, so now in that case, that's why people want to take advantage of the arbitrage. As soon as they arbitrage, then cryptocurrency, in that case, you want to make sure that you act as quick as possible to take advantage of the arbitrage opportunity. So, of course, in financial econometrics or in a financial market, we enforce that the law of one price must hold. But there are simple cases whereby the arbitrage opportunity does exist, and the people want to make sure that they take advantage of the arbitrage opportunity. Like in terms of cryptocurrency trading, you want to make sure that you react as quick as possible to if you see an open opportunity for arbitrage. Yeah.
Thank you. And I think you forgot to hit the send button on your chat because the textbook hasn't come up yet.
Oh, okay.
Oh,
No,
now
I
you
can
got it.
solve the mystery. I just reposted it. Mesias just emailed it to me, message it to me.
Oh,
I didn't notice it either. Yeah, sorry.
oh, okay. Okay,
No, there
sorry.
is the option to message the panelist or everyone, and probably by default it goes just to me. And I saw it. That's why I didn't think about it. Sorry. I just reposted it. And I just missed a letter O, the first O I missed. Okay, excellent. Are there further questions?
Yes, there is one question that how does the bond type at different coupon value affect the compounding value at maturity, or it doesn't matter because the law, yeah, no, it doesn't matter because of law of one price or no arbitrage. It doesn't really matter.
Excellent. Yeah, let's see. If there are no further urgent questions, then we are done for today. And Mesias, I saw in the chat that there was the request to access the slides. Will you be willing to share them with us so that we can put them on the website next to the link to the videos?
Yes, I'll do that.
Perfect. That's excellent. Fantastic. Thank you very much, Mesias. Thank you very much.
No worries. And thank you guys for coming to my lecture. I hope to see you next week again and really dive deeper into the real stuff of quantitative finance. Thank you.
Excellent, excellent. And I see there are lots of clapping hands and hearts coming up the screen. So well done, Mesias. Thank you very much. It looks like everybody thoroughly enjoyed your lecture, and